It's going to hurt. You know, historically, whenever they brand a piece of legislation, whatever the name is, the effect will be the opposite of that name. So if a bill is called the Inflation Reduction Act, then you know right off the bat, the effect of the bill is going to be to increase inflation. And that's exactly what it's going to do. First of all, there's all this new government spending. That's more demand, artificial demand, coming into the economy. How is the government going to get all this money that it's going to spend? Because it's not going to get it from those tax hikes. It's ultimately going to get it from the Fed. The Fed is going to have to print more money to monetize those debts. Now, even if the Fed doesn't do that, and the government has to find private buyers for those bonds, well, then the government, or rather the Treasury, has to find private buyers for those bonds. It's going to crowd out investment in the private sector. And so that's going to mean fewer things are going to be produced because the private sector is going to have less money to invest in capital and things to improve productivity. And so that ultimately causes prices to be higher. So will the increase in corporate taxes, because to the extent that corporations have to pay higher taxes, it comes at the expense of lower investment. So if corporations have less money to invest in plant and equipment and expanding supply, that ultimately puts upward pressure on prices. What the government needs to do to reduce inflation is reduce government spending. We need a bill that cuts government spending. The government is doing the opposite. They are increasing government spending. So what they're doing is they are throwing gasoline on a fire that's already burning hot. They still remain hopeful that the Fed's going to be cutting interest rates by next year. Now, in fact, they may be cutting interest rates before the end of this year. But it's not going to be because they've won a victory over inflation. It's going to be because the economy is in a much more severe recession than the one it's in right now. In other words, this recession that's here is going to get worse, and that's going to force politicians to try to do something. You know, once the political pressure is greater because of unemployment and the economy, then the Fed is going to switch its attention from inflation. But the inflation problem is not going to go away. It's just that this other problem is going to loom larger in the eyes of the Fed. And I think what's driving the markets is this bad news on the economy is good news for the markets, because it means the Fed will pivot sooner. And before it pivots, it will raise rates less than it might have raised, absent the bad economic news. And again, you still have all of these Keynesians out there that think bad economic news is good news on inflation. They think the weak economy will weaken inflation. It won't. It is going to strengthen inflation, especially when the Federal Reserve and the government respond to the weakening economy with more stimulus, because that stimulus is inflation. So they're going to start creating more inflation, even though we already have too much inflation. And so the problem is going to get much bigger than the markets understand. You know, I still think this is an overall bear market. I think that rate hikes are going to continue to take their toll, but so will inflation. I think inflation is going to harm a lot of companies that have a problem dealing with it. I think a lot of demand is going to be destroyed for a lot of discretionary items, because people are going to spend all their money on food, on energy, on insurance, on rent, on taxes, you know, especially if we get another, 80,000 IRS agents that are going to be harassing the middle class, a lot of small business owners and the people who are self-employed. They're going to be spending a lot of energy dealing with the IRS that they won't be able to spend working. And then the IRS is probably going to shake them down for some additional taxes, interest, penalties. So people are going to be dealing with that. And that's going to be another problem for companies trying to sell American consumers products when they're broke. There are a lot of companies that are losing money. I think last year we set a record for IPOs of companies that lose money. And so all of these companies, zombie companies, are creatures of the bubble that was inflated by the Fed with inflation, artificially low interest rates, zero interest rates, and quantitative easing. That's what gave birth to all of these zombie companies. And now that the Fed is raising rates and is no longer doing quantitative easing, all these zombie companies are going to die. And it's a lot more than just Coinbase and Netflix. And, you know, I don't think Netflix is going to go away. I mean, I think Netflix is a viable business, but investors have way overpaid. It's very competitive now. There's so many streaming services out there, and the public can't afford them. I mean, they don't have enough money for all this content. And so there's a lot of competition. It's very easy for people to subscribe to one of these services for a week, binge watch whatever they want to see, then cancel their subscription. It's very easy to just use a family member's subscription, a friend's subscription. So people are going to find a way, to circumvent a lot of this. But companies like Coinbase, I mean, that's all part of the crypto bubble. I think most of the blockchain crypto-related companies are going to go out of business. I don't think they have viable business models. I don't think most of these cryptocurrencies are viable. In fact, I don't think any of them are. I think all of them, including Bitcoin and Ether, are ultimately going to zero. It may take a while before they, flatline completely. There'll always be some fools willing to buy, thinking they're going to get a bargain. But I don't know how long a lot of these companies will be able to stay in business and keep writing paychecks when they no longer have access to capital, because they don't have any earnings to fund their operations. They rely on selling stock to investors who just believe that they can buy the stock and the price will go up. But when that fantasy meets reality, these companies are not going to be able to access any capital, and so they're going to have to slash their workforce, and many of them will end up just going out of business completely. I think the nature of this financial crisis is going to be a lot different than the one we had in 2008, because I don't think the Fed is going to allow it. That's one of the reasons I believe that Powell is going to pivot, because if the Fed does keep raising rates, we will have a financial crisis that looks like 2008, only much worse. Because 2008 was about bad debt. It was about people borrowed money and they couldn't pay it back, and the collateral for the loans was no good because it was real estate and prices went down. Well, we have much more debt now than we had in 2008. I mean, by an order of magnitude. Everybody has more debt than they had back then. And so this is going to be a much bigger crisis when the defaults start. And all those banks that were too big to fail, that were bailed out in 2008, they're a lot bigger now. And when they fail, it's going to be a lot worse, except with inflation too high and the Fed fighting inflation, there are no bailouts. There's no TARP 2.0. All these banks are going to have to be allowed to fail. And that means customers are going to lose money, not just stockholders or bondholders. The customers are going to lose money because the FDIC doesn't have any money unless it gets it from the Fed. And the Fed isn't going to be giving out money if it's fighting inflation. It's taking away money. So I believe the Fed is going to pivot to prevent that massive financial crisis. And so what we're going to get is a sovereign debt crisis and a US dollar crisis. So it's going to take the form of a crashing dollar. And so the people who are going to lose money are not the people that are just holding subprime mortgages, but the people who are holding US Treasury bonds or any bonds denominated in US dollars, or even people that have US dollars stuffed under their mattress. The dollar has risen so far in the early stages of this big inflation because investors are still delusional about the Fed's ability to contain inflation and bring it back down to 2%. When they wake up to reality that inflation is going to be way above 2% indefinitely, then the dollar is going to fall through the floor, and then things like gold and silver will go through the roof.